Millions of people open brokerage accounts every year. They deposit their cash, start swiping through trending stocks, and imagine a future of effortless wealth. Without realizing it, they are approaching the market like a casino floor. This chart tracks the mathematical reality of the stock market. Over the long haul, adjusted for inflation, the market follows a steady upward trajectory of about 7 to 10% per year. Yet, despite this reliable historical growth, the vast majority of first-time investors see their portfolios shrink. They lose money. Human beings are biologically hardwired to make specific, predictable cognitive errors that destroy wealth, errors that occur regardless of how well the underlying companies are performing. By conducting a psychological autopsy on the beginner's portfolio, we can isolate the 3 specific behavioral traps that cause these losses and map out how to survive them. The first trap targets the brain's reward system. We are evolutionarily drawn to rapid, dopamine-fueled payoffs rather than the slow, invisible process of multi-decade compounding. Social media influencers exploit this through authority bias. When a charismatic personality speaks with absolute certainty about a hidden gem stock, we instinctively overtrust their confidence, even when they have no verifiable expertise. The 2021 GameStop saga demonstrated the chaotic result of this social-driven trading. Online hype pushed a struggling retailer stock to extreme heights, leading latecomers to buy in right before the valuation collapsed. This trend is reinforced by survivorship bias. Algorithms show us the few people who turned small sums into millions, while the thousands of silent investors who lost everything on the same trade remain invisible. Watching those few winners triggers a deep fear of missing out, or FOMO. It weaponizes our herd mentality, causing us to follow the crowd into a bubble simply because everyone else seems to be getting rich. Chasing viral stocks is a biological impulse rather than a financial strategy. Giving into that impulse usually ensures that an asset is purchased at its most inflated price. The second trap relies on the ego-driven belief that we can successfully pick individual winners and time the market's complex swings. Data from research firm Dalbar highlights the cost of this belief. While the S&P 500 maintains a high, steady curve over 20-year periods, the average individual investor drastically underperforms the very market they are trying to outsmart. This gap is driven by loss aversion. To the human brain, the pain of losing $100 is psychologically twice as powerful as the pleasure of gaining that same amount. This skewed emotional wiring drives investors to buy at the peak out of greed, and then, terrified by temporary price drops, panic sell in the valley. Active trading carries further silent penalties. Frequent movements trigger short-term capital gains taxes and accumulate transaction fees that compound against the investor over time. Broad diversification provides the only mathematical defense against these active errors. Spreading capital across different sectors removes the catastrophic risk associated with a single company's failure. When a market correction hits, price swings create a sense of panic. However, real risk involves the permanent loss of capital through business failure or being forced to sell your holdings at a depressed price. Active control is a mirage. Market survival requires overriding emotional panic with widespread, diversified assets. The third trap is investing without a plan or a safety net. It is the financial equivalent of getting into a taxi with no destination. Putting cash needed for a short-term goal, like a house deposit, into volatile stocks ignores the market's unpredictable nature. Short-term fluctuations can easily erase the money you need to spend tomorrow. This split screen shows a sequencing error. On the top, the stock market takes a sudden dive. On the bottom, at that exact moment, an unexpected emergency expense arrives. Without 3 to 6 months of expenses in a liquid bank account, you are forced to sell during the dip to cover the bill. This permanently locks in a loss that might have otherwise been a temporary market fluctuation. Lacking the foundational shield of an emergency fund turns an investor into a hostage to random life circumstances. Overriding these biological glitches requires a system that removes human emotion from the equation entirely. Step 1 is securing the base. This means paying off high-interest debt and fully funding a liquid emergency savings account before investing a single dollar. Step 2 is neutralizing the pressure of market timing. Automating regular, fixed contributions into broad index funds, regardless of daily headlines, harnesses the power of dollar-cost averaging. Step 3 is extending the time horizon. Real investing is a multi-decade journey of compound interest, which Albert Einstein reportedly called the eighth wonder of the world. Warren Buffett famously characterized the stock market as a device for transferring money from the impatient to the patient. Sustained financial freedom grows from a boring, rational plan. By controlling individual impulses and letting time do the heavy lifting, the math handles the rest.